Wall Street firms trying to meet demand, including our next guest company, which pioneered the mutual fund, now pivoting to active ETFs, which have seen over $250 billion of inflows year to date. Joining us this morning is MFS CEO Michael Roberge. Welcome back. Congratulations.
Thank you. Welcome. Glad to be here.
Brought a huge crew. Talk about where active sits right now in the year it's having versus passive.
Well, what's interesting is MFS launched the first mutual fund 100 years ago. And, that was a seminal event that for the first time allowed individual investors to invest in the markets. And so we're super excited about the 100-year anniversary. We celebrated that earlier in the year. And now, we issued 5 active ETFs last week. And it's really about taking existing capabilities, putting them in the ETF vehicle, which is more tax efficient for clients. And so launching the first mutual fund, excited about that. And now on the floor this morning, celebrating the launch of the 5 active ETFs.
What do you make of some of these inflow numbers that we've been getting, really the last 9 weeks or so?
Yeah, much of that has been going to passive, sort of the index, rather than the active vehicles. But we do see a lot of demand for clients looking for active, risk-managed product, and those are the capabilities that we're bringing within our ETFs.
What is the mantra these days in terms of defending active management versus passive? I'm sure you've got it down. I'm sure you have to. I speak to a lot of active managers all day for my job, but many of them trail the markets. Often they use risk adjusting as sort of one of the keys as to why they do it and why you should still want an actively managed portfolio. What do you say?
I think the biggest challenge, if you think about the indices themselves, is fully diversified, really diversified indices have been much easier to beat for active managers. It is those indexes that include U.S. equities with the Mag 7 in them that have been very difficult to beat, because most managers run diversified portfolios where you're limited. The top 5 names can't be more than 25% of your portfolio. So by definition, you can't be overweight Mag 7. And so we've done a lot of work around this. When the market becomes as concentrated as it is today, those areas of the market tend to underperform in the future. So we think clients should be looking to broaden their exposure away from the Mag 7. We think some of those indices are actually risky today.
Yeah, so it's a worrisome sign that 31, it depends on the day, 32% of the S&P is obviously concentrated in 7 stocks. Is that concerning for you overall for the market?
Yeah, and if you look at the Russell 1000 growth, it's almost 50%. And so it is concerning because ultimately we think the market will rotate away from that. And people, to the point on flows, are going to be incredibly exposed to that because that's where flows have gone, trying to chase that U.S. exposure.
So what should they be diversifying at this point into? Because they're still pretty dominant and driving the market nearly every day.
I think if you think about diversifying into fixed income would be one way to diversify value relative to growth. Those Mag 7 stocks, it's all growth and momentum. And non-U.S. stocks, which have trailed U.S. stocks pretty meaningfully.
Yeah, although, some point to the PEs of an Alphabet, for example, or a Meta and say, really, they're kind of value and growth, to be fair.
Yeah, but they're, the growth rates on those stocks, the way that they'll end up underperforming is growth disappoints and the multiple gets cut. That's historically how it has. They're still good companies. They'll be good companies well into the future. But when growth slows relative to expectations, the multiples will come down, and that's how they'll underperform. And we've seen that happen historically.
We're in a period of real policy uncertainty. We're not going to know a lot for the next few weeks. The Fed's not going to know. Corporates aren't going to know when they do Q4 earnings. How are you thinking about the market's ability to price in some of those turns around the corner?
Yeah, I think the market's waiting for the next administration. And, the administration inherits a really strong economy, inherits a very strong labor market. And I think policy from here will dictate what the Fed does and how the markets ultimately respond to that. I do think the markets, if you look at how equities have continued to melt up, as you said earlier, I do think the market is not anticipating worst case on tariffs, on deportations that impact the labor force. And to the extent that that stays true, I think the market is appropriately priced. If those things become riskier for the market, I think there is some downside for the market.